So when you start a brand new business, one of the fundamental decisions is how are you going to capitalize that business? Because remember, a brand new business is like a baby coming into this world. It has nothing. It has no resources. So we have to decide whether we should finance a business with debt or with equity. So in other words, should we talk to some lenders, maybe a local bank, a rich uncle, some other people that we know that have resources, or should we go over here and should we talk to potential investors? Now the reality is it's probably going to be some blend of the two. It's probably not going to be 100% debt financing. I suppose there are situations where it could be 100% equity financing, but I don't know too many lenders that would like to take the entire burden. Most lenders want to see some skin in the game from investors. Think about this. Perhaps you have a car loan, maybe you have a mortgage, and I can almost guarantee you that somebody required some sort of down payment. Okay? Especially if you want the best rates, you're going to have to put down some kind of down payment. That's what equity is. So the capitalization of the business really needs to be most likely some blend of these. Let's talk about some of the advantages and disadvantages. Let's talk about some of the advantages and disadvantages of using debt as a form of financing your company. One potential advantage is this concept of leverage. If you use other people's money to earn a profit, you certainly can create financial leverage. Now, that doesn't come without a risk. Think about it this way. So let's say that you pay 5% interest on your loan, but you can earn a return greater than that by operating your business at a profit. If you're successful with this strategy, you create financial leverage, and that's a wonderful situation. However, think about situations where times are tough, where operating cash flow is suffering. Maybe you're even operating at a net loss or something like that. Suddenly that leverage, which looked so good when times were great, is pretty risky. That lever can come back and hit you in the face, and it could hurt because there's not a lot of flexibility with debt. Now, there are some other advantages though. Preservation of control. So in other words, when you borrow money from somebody, they don't have equity ownership in your company. They don't have any votes. So you keep control of the business. You keep the ownership. And also, when you pay them, because part of leverage is paying interest to the lender, those interest payments that you make are typically tax deductible. Okay? Obviously, the Internal Revenue Code is a complicated animal, but as generally conceived, interest payments are tax deductible. Let's contrast that over here with some of the disadvantages. We already talked about one. Leverage can be an advantage, but it can come back and bite you and be a disadvantage. Repayment requirements. There's not that much flexibility when it comes to debt. Once you sign up for this loan, the lender is going to want regular periodic payments of principal and interest. And if you don't make those payments, the lender has recourse. They can do things. They can call the loan. They can collect collateral, right? So it's not quite as flexible as with the equity that we're going to talk about in a few minutes. Loan covenants. Most business loans have some kind of covenants written into them. A covenant is a promise. So what a loan covenant is when the borrower makes promises to the lender. And loan covenants can get very creative. This is whatever the lender wants to put in there, because loan covenants are in place to protect the lender. A few examples, maybe the loan covenant says that the company needs to maintain a current ratio in excess of a certain amount. Or maybe they need to have a minimum EBITDA, earnings before interest, taxes, depreciation, amortization. Maybe they need to maintain a certain level of working capital. These are just a few examples of really a wide array that lenders could choose. These covenants are some of the strings attached to a loan. And then finally, personal guarantees. A lot of times, especially for closely held businesses, the bank is going to require some kind of personal guarantee from the owner. May not be as prevalent with publicly traded companies. That's obviously a different situation. But if we're talking about family businesses, even large family businesses, there's a very good chance that the bank is going to at least request a personal guarantee, if not require that. Moving on to equity, What you might notice is that some of the disadvantages of debt become advantages of equity and vice versa. For example, remember that with debt there was not a lot of flexibility with the repayment schedule. There's ultimate flexibility with equity because repayment in the equity scenario is called dividends. And there is no requirement to pay dividends to the shareholders. The dividends will only show up if the board of directors declares a dividend and if the company can afford to do so, if it has the resources to pay the dividend. So shareholders are often in line last for payment. They're behind the suppliers, they're behind the employees, they're behind the bank. And then if there's enough money left over at the end of the period, maybe the shareholders get a dividend. Okay, so there is definitely that flexibility. Safer than debt? Absolutely, because of the flexibility. If times are tough, you can tell the shareholders, hey, I know you'd love to receive a dividend. We just can't do it now. Hold on, let's wait. Maybe we will have the ability to pay a dividend 6 months from now or a year from now or something like that. Try saying that to your bank and I think you know what the answer will be. Equity is really a long-term solution, right? Because if you think about it, shareholders, when they're investing their own money, they're all in, okay? They have skin in the game. They have bought into the company. Literally, they have bought into the company. Now, equity does not come without disadvantages. You're going to lose some control. If you are the 100% shareholder of your corporation and you need to bring some funds into that corporation and you're evaluating, well, should I issue debt by getting a bank loan or should I invite another shareholder to the table? If you invite the other shareholder, it comes along with these advantages, but you're going to lose some control. You're going to give up some ownership in the company. You're probably going to give up some voting rights in the company, right, in a lot of situations. So you might be sacrificing some financial gains as well, because later on, if the company does issue a dividend or at liquidation, when the company wraps up its affairs, either way, you're going to be sharing that pie with somebody else or one or more people. And then finally here, dividend payments are not deductible. One of the advantages of debt was that the interest payments are at least probably tax deductible. Whereas with equity, dividend payments are not an expense. They are a reduction of retained earnings. It's a reduction of owner's equity. That is true for GAAP financial statements. It's also true for your federal income tax return. There is no deduction. So what we're seeing here is really a disadvantage called double taxation if the company is organized as a C corporation. There is a possibility that you make an election to become a subchapter S corporation. That's a federal income tax election. And in that case, you may be able to mitigate the double taxation of dividends. But if it's a traditional C corporation, what's going to happen is the company will generate its profits, distribute those profits to the owners via dividends. That's not deductible for the corporation, but dividend income is taxable to the shareholder who receives the dividends. So you see, there's where the double taxation comes in. The company makes a payment and does not get a deduction. The shareholder has to include that same payment in his or her taxable income. So as you can see, there is no crystal ball that says, yes, it should be all debt. Yes, it should be all equity. It's probably a blend of the two, and we really need to look at the advantages and the disadvantages. And these are just really an overview of those advantages and disadvantages. What you really need to do is sit down with your key advisors, your attorney, your CPA, and talk about these options to see what is best for your business.